determine the value at expiration, profit, maximum loss, break-even underlying price at expiration, and payoff graph of a covered call strategy and a protective put strategy, and explain the risk management application of each strategy. Now, just like the previous video on individual calls and puts, we're going to tackle the same stuff here: value at expiration, profit, max profit and loss, etc. But this time with a specific focus on covered calls and protective puts. So before we start, let's quickly remind ourselves what covered calls and protective puts are. A covered call is a position whereby we own the underlying asset and we go short the related call option. A protective put, on the other hand, is a combination of a long underlying asset with a long position in a related put option. Okay, so first let's talk about value at expiration. Now, if we take each element in the covered call position and individually consider their value at expiration, we have ST, the value of the underlying asset at the expiration date, and we have minus the value of the call at expiration, which is minus the larger of 0 or ST minus K. If we put those together with a long position in the underlying and a short position in the option, we get the value of the position on the expiration date. Let's do the same thing for the elements of a protective put. We have the underlying asset and a put option. The value of the underlying at expiration again is ST, and the put option will have a value of either 0 or K minus ST depending on which is larger. If we put those together as two long positions, we get an expression for the value of a protected put at expiration. Okay, let's talk about profit. Just like the previous video, the profit of these positions is based on the difference between the expiration date value and the initial cost. With a covered call, we simply take the expression we have for expiration date value and account for the cost of putting together that position, which would mean the purchase price of the underlying asset and the initial premium of the option, which we receive because we are short the option. With a protective put, we again take the expression we developed for the value at expiry and account for the cost of the position, the cost of the underlying, and the option premium we paid to be the long party of this contract. Next, we'll look at maximum profit and maximum loss. Here's the formula for profit in a covered call again. Now, given that the initial underlying price S0, the initial call premium C0, and the strike K are all fixed numbers, we're going to do just what we did in the last video and adjust ST up and down to its limits to see how it affects the profitability of the position. First, we're going to assume that ST is greater than K, giving us a valuable option position. Working through the algebra, we find a known maximum profit amount of K minus S0 plus C0. On the other hand, if the underlying price falls, we have a worthless option, so this term in the expression becomes 0. If we take that scenario to the limit, reducing ST right down to 0, we get a maximum loss on the position of S0 plus C0. Basically telling us that the maximum loss in the position is equal to the cost of implementing it. Okay, so let's turn our attention to the protective put position and make the same kind of assumptions about ST to develop expressions for maximum profit and maximum loss. We start by assuming that the underlying price rises to infinity, the maximum that the underlying price can reach. If that happens, the option position becomes worthless, but the value of the long position in the underlying is pushed to infinity, so we can ignore costs as negligible amounts and call the maximum profit infinity. If, on the other hand, we were to assume that the price will land below the strike at expiry, then we have a valuable option position, but a weakened underlying position. Working through the algebra here, we end up with a known maximum loss on a protective put strategy of K minus S0 minus P0. Here's a summary of what we have just learned, the maximum profit and loss amounts for covered call and protective put strategies. On to the next step, the outcomes for investors. In this section, we're going to look at the uses of covered calls and protective puts in terms of risk management. The purpose of a call option is reduction in risk. In bull markets, gains from wild upward swings are forgone, but in bear markets, losses are softened by the option premium. Initially, this sounds like an utterly unwantable situation, limited upside and unlimited downside, but it's important not to forget the likelihood of events actually occurring. For example, for us to be limited on the upside, the underlying would have to experience a really dramatic increase. More often than not, it would have to be a highly unlikely upward move in the underlying for us to be halted at the max profit line. Another major factor to be considered here is the selection of the strike price on the option. A lower strike will mean a higher option premium, but it brings the maximum profit we can earn on the underlying right down. If we push the strike higher, we allow the possibility of earning more on the underlying before reaching the max profit ceiling, but the option premium we get in the beginning will be much smaller. There is no easy way to determine the optimal level here. It's going to be dependent on risk tolerance. With protective puts, we are protecting our underlying position by holding a put option. Increasing losses on the underlying are offset by the increasing value of the option, so we still maintain the upside potential of the underlying, only shaving the option premium off the top. At first glance, this seems to offer a protection benefit similar to the covered call, but with a much more attractive upside potential. Again, we need to check if this is really the case. We claim to be protected on the downside. The major consideration here, though, is not how the downside has been limited, but how much upside we have forgone to implement that protection. Now, yes, the upside potential is unlimited, but in practical terms, we're going to have to overcome the option premium before we reach profitability. If we need the underlying to push massively to the upside to get us into a position of profitability, then we are going to have to reconsider the value of the downside protection. When even though we are not limited in terms of the value of the upside potential, the likelihood of reaching any profits has been severely limited. Again, another consideration here is the strike price. The put contract in the protective put strategy is very like an insurance contract. A higher strike price means more protection on the downside, but it will cost more. So the more quickly this insurance put contract pays out in the event of a downside move, the more it will cost us to implement. Again, risk tolerance is a factor in determining the strike level. There's no real optimal level. Next, the payoff graphs. Now, just like we did in the beginning of this video where we developed an expression for the value at expiration by combining the values of the assets that make up the position, we're going to do the very same thing to develop the payoff graphs. We're going to combine the graphs of the component parts to come up with the shape that relates to a combined strategy. For a covered call, we need to combine the payoff graphs of a long position in the underlying and a short position in a call option as shown here. Now, some students have trouble understanding this graph for the underlying, but remember, this is a graph of payoff. It's telling us that if the price rises, the position will be more valuable, but the payoff cannot be negative. That makes sense because we will never be required to pay out more after purchasing the asset. No change in price can lead us to owe more money. Now, if this was a profit graph, there would be some part of this in negative territory, but not a payoff graph. The resulting combination looks like this, showing the lower range where the option expires worthless and the value of the position is dependent on how low the underlying price goes, and the upper range where we have a fixed maximum ceiling profit. For a protective put, we need to combine the payoff graphs of a long position in an underlying and a long position in a put option as shown here. The resulting combined shape looks like this, where the put and the underlying offset each other when the price falls, and we have a linearly increasing profit position in the upper range, extending out to infinity for an ever-increasing underlying price. Okay, now we're on to the break-even underlying price at expiration. Here is the payoff graph for a covered call again. The first thing we need to do is account for cost and change this from payoff to a graph of profit. Now this is the point we're interested in, the point where profit is 0. Notice that this point happens at a point where the underlying price is lower than the strike of the option. So at break even, the call is actually going to be worthless. Let's take a look at the expression for profit in a covered call. If we set the profit equal to 0, we can find the break-even underlying price. Now the first thing we can do to break this down is to make the assumption that the strike price is higher than the underlying price and account for a worthless option. Following that, we rearrange the equation with some simple algebra to find the break-even underlying price at S0 minus C0. Now let's look at a protective put. Again, the first thing we need to do here is to account for costs and turn this payoff graph into a profit graph. And then we can see the break-even point we are looking for. Again here, it's interesting to note that the break-even point occurs above the strike, meaning that again, this option is going to be worthless. Taking the expression for profit in a protective put strategy, the first thing again we do is to set the profit equal to 0 so that we can find the break-even underlying price. After that, we can again remove the option payoff, since from the graph, we can tell that the option will expire worthless at the break-even point. With some basic algebra, we find that the break-even point happens when we recoup both the price of the underlying asset and the option premium we paid. The last piece of the derivatives material at last, the summary of break-even points on covered calls and protective puts. For a covered call, you have to recoup the amount spent on the underlying minus the option premium received. For a protective put, you have to recoup both initial costs.